Three powerful recession indicators are giving us urgent warnings. I'm going to explain this to you in three simple, fast steps. Step number one, the options market is predicting the unthinkable. What am I referring to specifically? Negative interest rates. And I'm not talking about real rates. I'm talking about negative nominal rates. So in other words, the market is giving a strong warning sign right now that in the very near future, the Federal Reserve will take the overnight Fed funds rate negative. This is what the experts like Mike Green and Jeff Snyder are talking about. Editor, let's cut to the clip.
One of the things that, unless you're very, very closely watching the euro dollar or Fed funds market, you might not be aware of is that the value of options that would pay off in the event that rates went negative in this next cycle.
Negative.
Those are still negative, right? Those are exploding in value at the same time that the perceived certainty of the Fed hiking is rising.
I mean, that's the ultimate tail risk hedge, right? I mean, it's the far left end of the tail.
Yeah, I mean, that literally is basically a bet that the Fed is going to completely throw in the towel and say, you know what, just everybody, you get a car, you get a car, you get a car, you get a car, right?
We're going Oprah here.
Welcome to the Jerome Powell Oprah show, right?
I want to start by looking at a chart from the Atlanta Fed. This chart begins June of 2022, so a few months into the future, and ends in March of 2025. On the left, we go from 100 basis points up to 450 basis points, or 4.5%. And this is a chart of the expected Fed funds rate moving into the future. This is really a range. So the red line is the bottom of the range, black line is the top line of the range, and the blue line is kind of the average right in the middle. And there's quite a wide variance as we move into the future, as you can see here. So it starts off with June, they're projecting that Fed funds rate is going to be about 150 basis points, or 1.5%. Going into June of next year, the average is about 3.5% on Fed funds. But the low is about 2%, high maybe 4.5%. But as you can see, this is kind of the line in the sand. From here, the market is expecting the Fed to start cutting interest rates. The middle of the range, they cut just very slightly. The top of the range, they maybe cut a little bit and flatten out. But the bottom of the range, they continue to cut all the way until they get back down to 1%. So how would this imply the options market is actually giving us a signal that they believe the Fed will actually take interest rates negative when we get out here to 2024, 2025, maybe even sooner? Well, here's how it works. There's an options market for euro dollar futures. So euro dollar futures, basically a bet on LIBOR, which is kind of a bet on the Fed funds rate. And as Mike pointed out in that clip with Jeff and Emil, the prices for the options that would be in the money, or the prices for the options that would pay out if interest rates actually go negative, have skyrocketed, meaning there's a lot more demand for those types of options. So the smart money in the options market for euro dollar futures is actually making big bets right now that in the very near future, the Fed will take interest rates negative. This is a huge recession indicator. So the price on the options that pay out if interest rates go negative have been exploding higher. This means that the probability of negative interest rates in the future is also exploding higher. And why would the Fed do something so extreme with interest rates? Because at that point in time, we would either be in a recession, if not an economic depression. Step number two, the next powerful recession indicator that is giving us an urgent warning is incomes are actually going down. Let's start by looking at a chart of the savings rate in the United States going back to 2010 all the way to today's date. On the left, we go from 5% up to 35%. And as you guys know, in the United States, with Americans, our savings rate historically is extremely low. Well, at least going back the last couple decades. So we start at 5%, but if you actually look at the data and the way this number is calculated, it definitely overestimates the level of savings. But that's a separate topic for a different video. So we come along here, 2013, it spikes up a bit. I think this is because they had a change in the way that they measure it, but still typically below 5% or right around 5% until we get to the cerveza sickness, and it goes up to 35%. Number one, people weren't spending money. Number two, the government was sending them all of the PPP loans and the stimmy checks. So when the stimmy checks run out, of course, the savings rate goes way back down. When they get the next round of stimmy checks, savings rate goes up. But then when they spend all of the money, now all of a sudden, their savings rate plummets back down to a level lower than it was before. So this is a very ominous sign, especially when you combine that with another two factors here. Let's start with credit card debt. We'll go in reverse order. Credit card debt going back up to an all-time high or very close to it. But what's very alarming is the rate of increase with credit card debt is really skyrocketing. And as we know, credit card debt is not set at a fixed rate like a 30-year mortgage. So what's going to happen to that debt load on the consumer, on the savings rate, on incomes, if Jerome Powell continues to raise rates up to 2%, 3%, maybe even higher? That would increase the probabilities of a recession, therefore increase what we were talking about in step number one. They would actually break the economy, break the market to a point where they would have to dramatically lower rates, maybe even take rates negative. But the main takeaway from this step number two is the fact that incomes themselves are actually going down. So it's not just that the savings rate is going back down to almost an all-time low, and we can see this because credit card debt is exploding higher, but the actual incomes, people's take-home pay when you adjust for inflation, is going down significantly. So editor, let's cut to this article from CNBC, and we can see just in the month of February, incomes were down 0.8% when you adjust for the rate of inflation. And keep in mind, those are the bogus government numbers they're using for the adjustment. If you use the actual inflation numbers, incomes would be down even further. And we can also see this in the data from the BEA, the Bureau of Economic Analysis, where they're saying incomes overall went down by 0.2% when you adjust for inflation in the month of February. Whoa, time out. I want to clarify some of the numbers. CNBC is getting this decrease of 0.8% from the Bureau of Labor and Statistics. This is from the month of March. The BEA is using data from February. That's how they get the decrease of 0.2%. But I also want to point out that if you look at the BEA's numbers going back 2, 3, 4 months, the incomes in the United States for the average American have gone down every single month. And if we really zoom out and look at things from a 30,000-foot level, we see that there is another indicator that is giving us an extremely urgent warning. Editor, go ahead and throw up a chart of M2 money supply. And we all know that it grew pretty much parabolic from 2020 pretty much to today's date. But what we can see just recently is the level of M2, in other words, the dollars that are chasing goods and services in the United States, has started to plateau. And if you go back just a month or two, we see that M2 actually momentarily went down. So my point is, if this trend continues, where the banking system isn't creating a lot of additional dollars, and the United States government isn't creating a lot of dollars through deficit spending, this could not just be a warning sign, but it actually could trigger the next recession. Unfortunately, the United States economy is dependent upon the money supply increasing at all times. Because sovereign debt, corporate debt, and consumer debt are at all-time highs, if you have fewer dollars circulating the system, this means aggregate demand goes down. If demand goes down, so does GDP. And this is an indicator that implies the odds of a recession are going straight up. Step number 3, our third powerful recession indicator that is giving us an urgent warning is the fact that mortgage rates are not just up, they are way up. Let's look at this chart going back to January of this year. The 30-year fixed rate mortgage was at 2.7%, and that has gone parabolic, almost doubled to 5% where it is today. In fact, today it's over 5%. Now, let's think this through. I always say that energy is the economy, and that's a very true statement. But in the United States, you've got to take it one step further. I think that housing is the economy. We know what happened to the economy back in 2008, 2009 when the housing market collapsed. It took down the economy with it. And we know that as interest rates or mortgage rates increase, this reduces dramatically the purchasing power for potential buyers. But another thing that's just as important that might not be obvious is that when rates go up, it pulls demand from the future. Editor, go ahead and throw up that Google search that we did earlier. And you can see that all of the mainstream media financial outlets are talking about how people are rushing to buy a house right now or do whatever they can to buy a house because they want to lock in a low interest rate. So you have this interesting dynamic where as mortgage rates go up, it decreases the purchasing power, but whatever purchasing power there is being utilized right now or has been utilized over the past few months. So it begs the question, who are the buyers going to be in the future if all of them are buying right now, and or if mortgage rates go from 5% to 7% up to 10% and the affordability continues to decrease? I understand there's very short supply, but at some level you decrease demand enough through the mortgage rates that prices will go down. Let's just go through a quick thought experiment so we can get our head around this. This is an example. Let's say mortgage rates went up to 15, 20%. What do you think that would do to demand? And what do you think that would do to prices? That would obviously decrease demand enough to where even if we were at all-time lows, as far as the available housing stock for sale, nominal prices would still go down. And I want to be very clear, I'm talking about nominal prices right now. If we adjust for the rate of inflation, the real prices would be going down at an even faster rate. But the story doesn't end there. If we pull up the last post from the Google search, we can see that it wasn't about buyers rushing out to buy a house before interest rates go up. It was about sellers wanting to sell right now while the prices are still high. So we could be seeing a fundamental shift in the housing market right now that is being caused by these mortgage rates exploding higher, where instead of demand outweighing supply, for the first time since 2012, we have supply outweighing demand. So I'm not predicting a housing market crash, but I am saying that if interest rates, mortgage rates, continue to go higher and higher and higher, at some point the market has to break. But I don't know whether that number, that line in the sand, is 5% interest rates, 7% interest rates, or 10% interest rates. We'll have to wait and see. But the fact that these crucially important rates have almost doubled just this year is a very powerful indicator that we need to be paying attention to, especially when you combine that with the fact that the option market is warning us about negative interest rates in the future, and the average American's income is actually going down. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.